Welcome back to Gold Rush Reporter, where we uncover the real forces shaping gold and silver prices around the world. I'm your silver analyst, and today's story is one of the most interesting in recent months. Gold prices are climbing higher and higher, yet regular investors are selling. That's right. People are dumping gold while the price keeps going up. How is that even possible? Something doesn't add up here. And that's exactly what we're going to break down. Now, I want to ask you this. If the public is selling, then who is buying? Because the only way for gold to keep rising is if someone else is buying, and they're buying a lot. It's not the average investor, and it's definitely not the small retail crowd. The people behind this move are much bigger, more powerful, and far more informed than any of us. So, who are they? Let's explore. According to several analysts, including the always outspoken Peter Schiff, the ones doing the heavy buying right now are central banks, particularly foreign central banks. These are the same institutions that shape the world's monetary policies, manage national reserves, and decide how much trust they place in the US dollar. And when these institutions start moving their money into gold, it's a big signal. It means they're preparing for something. Meanwhile, silver tells a very different story. While gold is soaring toward new record highs, silver is struggling to even cross $24 an ounce. Why? Because central banks are not buying silver. They're buying gold. And that difference alone explains why gold is surging while silver stays behind. It's not that silver has lost its value, it's just not being hoarded by those with the deepest pockets. So, what are these central banks seeing that the general public isn't? Maybe it's about inflation, maybe it's about the weakening of global currencies, or maybe it's the early stages of a shift away from the US dollar, what many call de-dollarization. Whatever the reason, one thing is clear. The world's biggest financial players are moving quietly but decisively into gold. At the same time, data from the ADP Research Institute showed that US private payrolls for February came in lower than expected. This weaker job growth added fuel to gold's rally, keeping it near the $2,140 mark, even as Fed Chair Jerome Powell held back from announcing any rate cuts. That's significant. It tells us that the gold market no longer depends solely on the Fed's actions. The confidence in gold is running deeper than ever. And here's the interesting twist. While the general public is selling into this rally, major institutions like Citi are calling for record-breaking gold prices ahead. Their analysts expect a 25% chance that gold could average $2,300 per ounce in the second half of the year. That's not a small move. That's a new record level. So, now I want to hear from you. Why do you think central banks are quietly buying gold while the public keeps selling it? Drop your thoughts in the comments, because this mystery could define the next big move in both gold and silver. Stay tuned. In the next part, we'll dig deeper into how central banks like China and India are increasing their gold reserves, and what that means for silver investors like us. Let's dive deeper into what's really happening behind the scenes. When you look at the current gold market, it's almost like there are two completely different worlds. On one side, you have the public. Ordinary investors, small traders, and even some institutions selling gold during a rally. And on the other side, you have central banks, the real giants of global finance, quietly buying massive amounts of gold month after month. Peter Schiff, one of the most outspoken voices in the precious metals space, has been pointing this out for a while now. He says that the rise in gold prices is not being driven by hype or retail excitement. It's being driven by central bank accumulation. According to Schiff, governments around the world are preparing for a long-term shift in the financial system. They're not just buying gold for profit, they're buying it as a hedge against currency devaluation. The numbers prove it. The People's Bank of China has now increased its gold reserves for 15 straight months, adding another 10 tons recently, bringing its total to 2,245 tons. That's not a small number. That's strategic. At the same time, the Reserve Bank of India has also increased its gold holdings, adding about 9 tons, the biggest monthly gain since mid-2022. These moves aren't random. Central banks know that the current global economy is standing on unstable ground, and they're protecting themselves with something real: physical gold. Now, let's pause for a second and think about this. If central banks are buying so aggressively, doesn't that tell us something? They have access to data and forecasts that regular investors simply don't. When they start accumulating gold and reducing their US dollar holdings, it's a clear warning sign. They're losing confidence in fiat currency stability. This is exactly what's known as de-dollarization, the gradual process of moving away from the US dollar as the global reserve currency. And as the dollar weakens, something has to replace it in the balance sheets of central banks. That replacement isn't going to be another paper currency like the euro or the yen. It's going to be gold. Meanwhile, silver continues to lag behind, trading well below $24 per ounce. And the reason is simple. Central banks aren't buying silver. Silver has industrial value, yes, but it's not being stockpiled as a strategic reserve the way gold is. That's why, for now, silver prices are not catching up to gold's massive rally. But here's where things get interesting for us silver analysts. When central banks create this massive gold rally, they're effectively laying the groundwork for silver's next move. Why? Because eventually, the public will catch on. When the average investor realizes that central banks are hoarding gold and that inflation is still eroding fiat value, attention will shift to silver, the undervalued alternative. So even though silver isn't part of the current central bank strategy, its time may be coming. Historically, silver tends to follow gold, just with a delay. And when it does, the move is usually sharper and faster. In the next part, we'll explore how this strange market behavior, the public selling while prices rise, fits into the bigger financial cycle, and why this might just be the setup for silver's long overdue breakout. Now, let's talk about one of the most unusual things happening right now. Gold is reaching record highs while the public is selling it. That's not how markets usually behave. In a typical rally, excitement builds up, retail investors start buying more, and media headlines fuel the frenzy. But this time, it's completely different. According to reports, gold ETFs, which are funds that track the price of gold, have been experiencing net outflows. In simple terms, that means more people are selling their gold holdings than buying. Yet, the price keeps going up. How can that be? The answer, once again, lies in who's doing the buying, the central banks. As Peter Schiff explained, the reason gold is climbing while the public sells is because the smart money is moving in. The big players, central banks, sovereign funds, and long-term institutional investors are absorbing all the gold that retail investors are dumping. They don't care about short-term price movements. They care about long-term financial security. You see, retail investors are driven mostly by emotion. When prices go up, they get excited and buy in, fear of missing out. When prices fall, they panic and sell. It's a natural human reaction, but it's also the reason most retail investors end up buying high and selling low. Central banks, on the other hand, operate with a completely different mindset. They plan decades ahead, not days or weeks. The public is currently being distracted by things like Bitcoin and other speculative assets. Financial media outlets like CNBC are constantly pushing stories about crypto and tech stocks, while almost ignoring gold's breakout. Schiff pointed out that even when gold reached a new record, mainstream media barely mentioned it. Instead, they were interviewing billionaires like Mark Cuban, who claimed that Bitcoin is the new gold. But there's a massive difference between Bitcoin's rally and gold's. Bitcoin is rising mainly because of speculation and hype, people buying into exchange-traded funds, ETFs, and hoping for quick profits. Gold, however, is rising because central banks are dumping the dollar and moving into hard assets. One is driven by sentiment, the other by survival. This is where understanding market psychology becomes crucial. The average investor often misses the big picture. They look at short-term gains, while central banks look at global shifts. Right now, governments are positioning themselves for a post-dollar world, and that means the long-term value of gold is far from being realized. So, when you see gold hitting new highs, don't mistake it for a speculative bubble. It's a structural revaluation. The market is quietly acknowledging that fiat currencies are weakening, and gold remains the ultimate store of value. Meanwhile, silver is being ignored. But that's exactly why it's so attractive. Silver hasn't yet had its breakout moment, but history shows it always follows gold's lead. When public awareness finally shifts from hype-driven assets back to tangible value, silver could easily see a powerful rally of its own. In the next part, we'll discuss how central banks' continued gold buying and the Federal Reserve's cautious stance are shaping the next phase of this market, and what that could mean for both gold and silver investors heading into next year. Now, as we move deeper into this situation, it's becoming clear that central banks are reshaping the financial landscape. Their steady accumulation of gold isn't random. It's a calculated move that signals a shift away from dependence on the US dollar. Peter Schiff highlighted that this trend is part of a global de-dollarization effort, where countries are cutting back on their US dollar reserves and replacing them with real, tangible assets, gold. Think about it this way. When a central bank decides to sell off billions of dollars worth of US treasuries or foreign currency reserves, they have to put that value somewhere. They can't just let it sit idle. And that's exactly why they're choosing gold. It's real money, independent of any government or central authority. Schiff emphasized that the dollar is being replaced not by another paper currency, like the euro or yen, but by gold itself. This is a major development because it represents a return to sound money principles that haven't been seen since before 1971, when the US completely detached the dollar from gold. Since then, global currencies have floated freely, backed only by government promises and public confidence. But confidence is fading. Central banks see what's coming: inflation, debt crises, and loss of purchasing power. So they're getting ahead of it. Interestingly, while central banks are buying gold aggressively, they're ignoring silver. Schiff made an important observation. Silver hasn't reached anywhere near its previous all-time high, still trading under $24 per ounce, because institutional buyers like central banks don't accumulate it in large quantities. This lack of official demand keeps silver undervalued, for now. But as retail investors and industries eventually catch on, silver could experience explosive gains, closing that gap with gold. What's even more surprising is that the public is helping central banks by selling their gold. Schiff described how ordinary investors, misled by financial media and short-term market noise, are unloading their holdings, effectively handing over their wealth to the very institutions preparing for a financial reset. It's a striking contrast between smart money and emotional money. Central banks understand that paper wealth, like stocks, bonds, and fiat currencies, can lose value overnight in a crisis. Gold, however, doesn't rely on anyone's promise to pay. That's why they don't care if the price goes up or down in the short term. They're not trading gold. They're accumulating it as a lifeboat asset. For investors like us, this presents an opportunity to observe and learn. When the world's biggest financial players start shifting their strategies, it's not just a market move, it's a message. The writing on the wall is clear. Fiat money is losing trust, and gold is regaining its role as the anchor of real value. In the next and final part, we'll explore what this all means for individual investors, why silver could be the next major play, and how the smart money versus retail divide might shape the markets in the months ahead. Stay tuned till the end, because this is where it all ties together, including what moves you should consider next. So here's where everything comes together. What we're seeing right now isn't just another short-term price movement. It's a major financial shift happening quietly beneath the surface. Central banks are positioning themselves for the long game, and they're doing it with gold. They aren't chasing profits or trying to time the market. They're safeguarding their nation's wealth against a system that's slowly losing credibility. Meanwhile, the general public is doing the opposite. They're selling into strength, distracted by flashy headlines about Bitcoin, tech stocks, and other quick profit trends. It's ironic. The same people who should be protecting their savings are helping central banks buy more gold at better prices. It's almost like history repeating itself. The few who understand what's happening quietly accumulate, while the majority react emotionally. Peter Schiff made it clear. The price of gold has no real ceiling. As long as the dollar keeps losing purchasing power, gold can continue to rise indefinitely. On the flip side, silver remains massively undervalued. And while central banks may not be buying it, retail investors still have an opening. Silver tends to move late, but when it does, it moves fast. We've seen it before in every bull cycle. So, as an analyst, my view is simple. We're witnessing the setup for the next major run in precious metals. Gold is leading the way, but silver's time is coming. The fundamentals are there: rising global debt, inflation concerns, and a shift away from the dollar-based system. When confidence in fiat money weakens further, silver could easily follow gold's trajectory, possibly outperforming it in percentage terms. And that's why I always remind my viewers, don't focus too much on the daily fluctuations. The bigger picture is what matters. The long-term trend is where the real gains are made. Central banks aren't trading gold week to week, and neither should we think in those short windows. The smart approach is to build positions gradually and hold with conviction. Now, before we wrap up, I want to hear from you. What do you think about central banks buying gold while the public sells? Do you believe this could be the beginning of a long-term shift in how value is measured globally? Drop your thoughts in the comments below. I read every one of them. If you found this breakdown helpful and want to stay ahead of these global market trends, make sure you subscribe to the channel, hit that like button, and turn on the notification bell so you don't miss any of my updates. This is Gold Rush Reporter, your daily source for real analysis on silver, gold, and the changing financial world. Thanks for watching, and I'll catch you in the next one. Stay sharp, stay informed, and keep stacking smart.